Hi, my name is Jay Goldschmidt. I'm with a realtor out of Minnesota, and I'm just doing a quick video kind of talking about the difference between FHA and conventional loans. And so we'll just kind of dive right in. We'll try to make it fun, make it easy, and make it understandable, and make it just make it make sense, really. That's kind of my goal for today. And so with it, FHA is also known as Federal Housing Authority, which is a which is a program under HUD, which is a federal backed loan, federal or insured loan. That's a better word for it. And so what that means is that it doesn't insure you, the buyer, or you, the person who, the person who's buying the home. It insures the person who is giving you the loan. So if you would default on the loan, they would get paid back. And so that's kind of their job. The difference with that and conventional is that with FHA, you can have poor credit. Your minimum down payment is 3.5%. There's some or down payment assistance programs out there that can help you with your down payment, so you can have little to no money for down payment, but you want to look at the fine print, make sure you read it, understand it, because it can be a little tricky with that stuff. So I just always want to make sure you know what you're getting into before you get into it, because realistically there's no free money out there, no matter how they kind of explain it. So just knowing what you're getting into. FHA, the big difference between FHA and conventional loans is conventionals aren't insured by, are guaranteed by the federal government, where FHA is. So with FHA though, you're going to be paying a premium insurance on the loan. And so what that means is that you're going to pay more money a month for your mortgage on the insurance. And so with FHA, you actually have to have 70% or 78% equity in your home before you can stop paying that insurance off, or you can stop paying that insurance. Where conventional, you have private mortgage insurance, also known as PMI. With that, you only have to have 20% equity in your home. And some lenders will actually let you, if your home appreciates value over a certain period of time, they'll let you write that off if you have it appraised. So usually if you're gonna get it appraised, it's gonna cost you about $500-600 to have an appraisal, depending on the size and price range of your home. But if you have 20% equity, just from average appreciation over a couple year period, you can actually write that off within 20%. But FHA is 78%, which is a lot more money that you have to put into your home before you can ever write it off. Yeah, and that's kind of it. The big differences, and even with like conventional, people get confused about it and they think there's a lot of you need perfect credit and stuff like that, and you don't. You need decent credit, and then you can do as little as 3% down payment, as much as down payment as you want. So just kind of having that in your mind. There's no really good or bad loan program. It's just what works for you and what's probably the best for you. And so it's kind of like conventional is kind of considered better for long-term home ownership. If you're going to live in the home for a long time, this might be a better idea for you. If you're going to live in your home for a shorter period of time, then FHA might be a good option, just because you're not going to have to be paying that insurance, that mortgage insurance, over the life of the loan. But there's a lot of different options and theories and different ideas out there that you can look into. But that's kind of the basic information about FHA and conventional. Thanks for watching my video. If you have any questions, I'll have my contact information down below, and please like this, and yeah, thanks. Have a great day.